What's up everybody, my name is Wes DeVore, and on this channel we talk about building surefire wealth over the course of 5 years or more, but really over your entire lifetime. Be sure to subscribe to the channel and smash the like button for more content like this. In this video I want to talk about 3 very important concepts that everyone should understand about the current landscape that we're in right now. If you want to build wealth over the long term, you absolutely need to understand and consider these perspectives that I'm going to explain right now so you can make the most informed decisions to grow financially. Now, disclaimer, this video is for entertainment purposes only. I am not a financial advisor. Your decisions in the stock market are your own responsibility, and for professional guidance, be sure to consult with an actual financial advisor or an accountant. So the first most important thing to understand is what is the Federal Reserve's monetary policy. So let's talk a little bit about what the Fed has been doing and how that affects what's going on in the marketplace. The Fed has been adding more money into the economy by buying up corporate debt in the form of bond ETFs. Now, when the stock market started crashing, the Treasury gave the Fed $75 billion, and the Fed leveraged the $75 billion 10 to 1 to create $750 billion that they used to buy up these corporate bond ETFs. Now, when the Fed purchases these bond ETFs, they are basically freeing up capital for the issuers of these bonds. And the easiest place for all this money to go is straight back into the stock market, which is one of the reasons for the incredible recovery we've had in the stock market since March. Now, looking back to the Great Recession of 2008, the Fed's intervention in 2009 was a major driver for the bull market that we've had since then. And since 2009, the stock market has gone up 4x, meaning that anyone could have doubled their money twice just by investing in index funds in 2009 with virtually no risk, which is pretty amazing. So now, looking back the past 11 years, what it has shown us is that if there ever is a crisis or a problem with the economy, which there was in 2008, 2009, and which there was and still is right now, the Federal Reserve has a track record of freeing up more money, and this keeps the markets at bay. Now, when the Federal Reserve's balance sheet's assets owned increases, what that means is there is way more money in circulation in the economy. The easiest place for that money to go is into financial assets, and that is exactly what we've seen and why the stock market has recovered the way it has since March, where it's basically impossible for us to run out of money because whenever there's a crisis, the Federal Reserve is able to just prop up the economy until there's a recovery. Now, the second thing we need to talk about is inflation. Now, inflation is extremely important to understand right now and looking forward the next 5, 10, 20, 30 years. What causes inflation? An increase in money supply and an increase in demand. So now, for the points I've just described, we have seen a mass increase in money circulation. So there was $750 billion that the Fed used to buy up the corporate debt, plus the remaining money in the stimulus package to send every American a $1,200 check. There is a whole lot more money in the economy. Further, interest rates are at all-time lows, which frees more money up to go into circulation. Okay, and now the reason why demand is going to keep increasing despite the current situation that we're in is we have global middle class growth that is unprecedented. In the next 10 years, the global middle class is projected to spend almost twice what they are spending now. And what does this mean for demand? This means they'll be buying twice as many iPhones, twice as many Teslas, twice as many subscriptions to Netflix, twice as many subscriptions to Microsoft Office, twice as many lattes from Starbucks. So with this new global economic paradigm of loose monetary policy, pushing stock prices up, a forecasted doubling of the size of the middle class in the next 10 years of consumer spending of the middle class, in essence, a doubling of demand, protecting yourselves from inflation would seem to be of a very high priority right now if you're looking forward about at least 5 years from now, and especially if you're looking forward 10, 20, 30 years from now. And the takeaway from this is that if you're not aggressively trying to accumulate financial assets during this paradigm shift, people are going to be left behind. The monetary policies are changing. In the next 10 years, I think it's going to be a time of mass growth with this loose monetary policy and inflation. The third and final thing that I want to discuss is the accelerating change change in the rate of technological progress. The world simply moves faster than it used to. Faster computers means faster ability to understand data. It means faster ability to innovate new solutions. And with loose monetary policy, that means faster ability for startups to materialize. And all of these solutions are going to be extremely valuable investing opportunities. So that was my outlook on the current landscape of the financial times that we're in. Over a 3-year period, I'm very bullish. I wouldn't invest if you have a smaller time horizon than that, like I always say on this channel. When investing for the long term, there is a risk that you will lose money in the short term. But if you dollar cost average when there are drops in the market and lower your cost basis effectively, if you're still accumulating financial assets through these uncertain times, history says that you're going to be just fine. Well, my memory card ran out there at the end of the video, so I just want to say thank you all for watching. Woke up this morning and the Dow did drop 800 points, but I'm not too scared because my outlook is definitely for at least 3 years or more. So yeah, we're in an exciting time, and just be sure to subscribe to the channel, leave a comment below, and I really appreciate it if you hit the like button too. So take care. I'll see you all in the next video. Bye.